It's an urgent alert. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, JPMorgan says it's not over yet as more selling is coming. I'm going to show you why JPMorgan says the carry trade that blew up the markets yesterday is not over yet. I'll show you who's buying the dip and why, and how the narrative is about to change to get more people to buy stocks. Now, let's head over to Bloomberg, where he picked today's story up with a headline: a $6.4 trillion stock wipeout as traders fearing a great unwind is just starting. And this is normally how you start to see the beginning of bear markets happen. You see something in the economic data, such as the payroll reports. You see selling from Warren Buffett and insiders. And next thing you know, something comes along and disrupts the market. And then that starts to get everyone concerned that there's going to be more selling. But yet, the allure of buying the dip is strong, and it's certainly buying in lots of people. And whether Monday's wild gyrations marked the final bang of a global sell-off that many are hoping is true, the start of the build last week or signal the beginning of a protracted slump is impossible to know. On Tuesday, some of the worst hit markets rebounded, with the Nikkei jumping more than 10% and U.S. stock indices moving higher. As we saw in Monday's trading, people rushed to buy the dip in a major way and are now seeing stocks at a huge discount, looking to buy even more. But will this work out? Well, we're going to see what JPMorgan has to say in a minute. One thing is clear, though: the pillars that had underpinned the financial market gains for years, a series of key assumptions that investors across the world were banking on, have been shaken. And that's a key point here. They've not just been shaken, they've been broken. And it's not just the fact that everyone bought into the narrative that we're going to experience a soft landing. It's we've seen carry trades like we saw on the yen that are now coming apart as central bankers try to fix the problems that they perceive are going on with their currencies. And yet JPMorgan says the carry trade unraveling is only half complete and there's more to come. And the question you might ask is, how did we know this was going to happen? Well, we have some predictive power with our reports, and our subscribers saw this, and we talked about this on the Sunday show, because we look at the machine positioning every day across the broad global equity markets, bond markets, commodities, and currencies. And because we run a historical overlay on what they use, we know where the machines are likely to go before they get there. That was our signal. You notice we nailed the call on small caps and large caps, and here you can see from a report what we look for is when they're in deep short positions and taking a reversal. That's the signal to buy, and right now we have an incredible signal showing up there, as well as on our Momentum Timer Pro report, where we look at the tactical signals of momentum over long time periods and even daily signals, and we see a big pullback in momentum like on this 1 month window, and then we see a shift into the buy signals. It flags on our reports and tells our subscribers to buy, and that is how we make a huge difference in your trading and investing. Because right now, while everyone's chasing the tech dip, we just put on a trade today to show our subscribers something sitting right near its 10-year low and has huge upside. Now you can get the daily report, the tradable signals. I give you my opinions on the ones I think you should do. We give you the stop loss levels. We track the trades and the returns so you can duplicate this to the penny, and we give you a weekly update on our stop loss levels along with a 30-day free trial. None of my competitors do that. That's how confident we are. Links in the description below. You don't want to miss out on this trade. If you think the equity market's where it's at, I'm going to show you exactly where to be. Because JPMorgan says we're not done by any stretch, as the carry trade unwind, at least within the speculative investing community, is somewhere between 50 to 60% complete. And what's nice for those people that are stuck in this carry trade, which we'll look at here in a moment, is the fact that all this dip buying's coming in, this flood of money is giving them a way to unwind some of their trades. And so this is just part of the story here of where we see sellers coming from, is those who are forced to sell. The nice thing is, whereas on Monday they didn't have any eager buyers because of course liquidity dried up, today on Tuesday they have a lot of US investors eager to buy, and that's all they need to continue to sell. And the yen carry trade, which is borrowing at low rates in Japan to fund purchases of higher yielding assets elsewhere, have long been popular among investors as volatility remained low and traders bet on Japanese interest rates would remain at rock bottom. So this was a bet on central bank policy, and that's what's key to understand here is you see the traders, investors, hedge funds, they all saw this as there's no way the Bank of Japan could raise rates or do anything to disrupt their low rate environment, and they did. And so what these traders were doing is borrowing at these ultra low rates and investing money elsewhere, and all of a sudden the Bank of Japan caused it all to unwind. But an 11% appreciation in the yen against the dollar over the past month has turned many of those trades into money losers, and that is causing what we call forced liquidation. And so what happens here is you see that they'll find a trade. In this case, it's borrowing money against the yen to invest elsewhere. But as the gap of that trade narrows, they continue to take it on, but they start applying leverage in their trades elsewhere, and that's exactly what happened here. The yen rallied, it squeezed them, they found themselves at a loss, and all of a sudden that leverage gets kicked out and it turns into a firestorm for the markets. Now, one of the issues here is people believe that, well, this was the only an isolated incident, and you see U.S. investors eager to come in and say, well, look, this just created a huge opportunity to buy a dip because those foolish leverage traders made a huge mistake. The problem is there's a massive amount of leverage under the U.S. stock market. As JPMorgan suggests, this is only about half done. The subsequent rush to close out yen short positions has jolted both emerging and developed markets that used to be destinations for investors deploying the strategy for higher returns. And what that does is it causes havoc across all of the major markets as it did. But right now, because of the money that's coming into the U.S. indices, as it sucks money up into, of course, as people think, this is a great opportunity to buy a dip. And this is important to understand where this view comes from, because in a bull market, what investors start to believe is that anytime there's a dip, you buy it because it's just going to go up. And the popular narrative right now is that we are in the early stages of a bull market, which would mean if there is a dip or something in the system glitches like we just saw on Monday with this carry trade blowing up, then you absolutely want to buy and buy as much as you can. The problem is if we're in the early stages of a bear market, then what you'll find is that the stocks will come down, people will jump in and buy them, and then it won't go up that much because there just isn't enough buyers here to support a further rally in equity prices. And then you'll see the economic data start to look weak, you'll see liquidity dry up, and next thing you know, instead of buying every dip on the way up, people will start buying the dip on the way down, losing money. And then when they get squeezed out, watch out, the bear market's on. A good case outcome is stabilization in the markets around current levels. At least that's the hope, and maybe a shallow recovery at best. But in many of these instances, you tend to get continuation of the moves if at lower velocity than what you had before. And that's exactly right. You see people rush in to buy this trade. Now, you might be wondering who was so eager. Well, we did see retail investors, but there was one giant big player that came in and bought this. And what they're hoping for is that other people follow suit. But if there isn't enough money in the markets or the economy to support these equity prices, it's going to run out of steam and head to the downside. And remember yesterday, we talked about the machine positioning. We talked about these vol control strategies. If we don't see markets settle down and quickly, what could happen is these machines are going to be forced to sell. And there's one thing that everybody agrees about in machines, is nobody actually knows how much money these algorithmic programs trade. But hedge funds were the big buyers. They bought the Monday dip as the fastest pace since March, and perhaps they were burned by listening. I love this. Now, former JPMorgan chief equity strategist Marko Kolanovic, because he's gone because he's too big of a bear. And what happened now is, for whatever reason, JPMorgan's trading desk yesterday urged institutions not to buy this dip. And again, it was consistent with their messaging here. They're saying, look, this carry trade isn't over. There is more to come out of the this market, and perhaps, as I suggested in yesterday's show, other opportunities to buy that will come if you're looking to do that. And here's the great thing, of course, our reports will help you with that, but nevertheless, hedge funds, they went ahead and bought the dip at the fastest pace in 5 months, primarily because hedge funds have been underperforming lately and are looking to try to get an edge to keep as much money under management. And yet a textbook turnaround Tuesday doesn't mean the meltdown is over, and that is a key point that JPMorgan is making, that I'm trying to make, is this may not be the bottom that everyone's hoping for, because in a bull market, that tends to be what happens. You see a shock move to the market, money floods in, and next you know, the price just continues to rally and rally and rally. But if it runs out of steam, that is a big red flag that perhaps suggests now we're in the early stages of a bear market. And still an even healthy Tuesday rebound in equities is unlikely to temper the broad unease growing across financial markets. Investors that buy and sell based on quantitative measures such as volatility. Now we're talking about these strategies like vol control strategies have offloaded $130 billion of stock bets in the past few weeks, and that process may accelerate in the days and weeks ahead. And that's exactly the key point. When we looked at all those machine positioning data, it didn't say over the next 1 day or 2 days. It says over the next month, if stock prices continue to head down or don't rebound, the machines are going to be forced to sell to control the risk. And that, again, it comes back to the fact that nobody actually knows where all the money is sitting and how much it's there. The nice thing is we gave you all those signals ahead of time. But investors hoping to catch the Tuesday upswing should be aware this may be only a short-term trade, and we'll keep an eye on that. And I wouldn't expect this to be a durable bounce, this from a chief investment officer at Vantage Point Asset Management. There's likely to remain volatility into October and November, and any counter-trend rally today and persisting for a few weeks should be something to trim risk into, particularly since we're in the worst month for flows. Now, perhaps one of the other aspects that's helping the market out right now is corporate share buybacks. And we talked about it on the Sunday show, which is really key to understand, if those are going to run till September 6th. So there's not a whole big window here where they're going to be buying and putting support under this market. What we do know is if we continue to see weakness in historical August outflows, this dip is going to be in the rearview mirror in the near term. And if you're looking for the Fed to come to the rescue, well, don't bet on it, as the Fed worries about systematic risk in financial markets, which is true, not disappointed investors who get blown up by a carry trade. Thus, the Fed is unlikely to change its course of action due to stock market corrections. Are we headed for a near-term recession, or the market's overreacting? We believe the slower growth is unfolding, not a recession. And this is where we're going to start to see the narrative change here, that this was just some aberration in the markets due to speculators betting on the yen and getting caught in their trades, and that maybe the economy is slowing, but perhaps it's not that bad. I'm going to show you here in a moment how the information on the economy is going to get everybody's interest into buying this dip, because remember, these hedge funds who are buying, they would love nothing more than you to buy after them. And volatility is likely to remain high in the near term, but we believe recession fears are overdone and that investors should focus on deploying cash. Here, see, you can see the narrative change in quality fixed income, tilting equity allocations toward quality stocks, which of course they mean by the big 5 or big 10, because that's what, well, everyone owns, and then diversifying your portfolio across asset classes. We look to New York Life and they say evidence that the prevailing soft landing view has forced the market to catch up to reality, but there's not enough evidence to merit panic selling and emergency acceleration of rate cuts. Again, that's absolutely right. We're not going to see, the Fed come out and even mention that this was a problem. They don't care about this correction. They're going to fixate on the economic data, and it's not their fault that, of course, people were betting on the yen. The reality is, though, we're now going to see a narrative change, and we first turn to the energy markets, where we see Aramco CEO says oil demand is strong. In fact, the means of prices at current levels are not justifiable, as recent sell-off is an overreaction. But the question is it an overreaction, or is it really a leading indicator of where the global economy is going? Because while stocks may have shock reactions, the energy market is all about economics and how we see economic demand. For in short runs, we do get speculative demand, but in the long run, it's all about economic growth trends. And right now, oil is suggesting it's not just people dumping it from speculative purposes. It's the fact that global economy is slowing. And Brent crude dropped almost 75 a barrel on Monday alongside a rout in global stock markets and has marginally recovered after a weaker than expected U.S. jobs report sparked fears of recession. Prices have stabilized today but remain near the lowest level since January, suggesting that something is indeed wrong with the global economy. And if that's the case, then it's not good news for the equity markets. Because when we look at crude oil prices, now we're going to shift from Brent over to West Texas Intermediate here, against the NASDAQ 100, and you can see that when the economy is slowing, demand for energy falls, that's shown in blue, and that leads to equity prices declining. So this could be just a simple case is that investors got excited about this AI bubble, front-run prices up, hoping for a bull market, or now find themselves that perhaps they got way ahead of economic fundamentals. Because we can go back even to the global financial crisis. The stock market was starting to cool off and then oil crashed. Guess what? Stocks crashed too. How about around 2015, 2016 when stocks were flat, oil was indicating demand was down. You see it again right around 2019. How about here again in 2022 into 2023? But look at now. This time you see investors saying, no, we're bullish. Oil energy markets saying, wait a minute, not so quick. But looking now at the U.S. data today, the trade deficit narrows to $73.1 billion as exports pick up. And this is going to turn into that, look, the U.S. economy's okay. This was, again, just an aberration in the trading markets from leveraged players getting caught in the wrong place at the wrong time because the shortfall in goods and services trade shrank 2.5% in June, while total exports increased 1.5%, while imports climbed 0.6%. Suggesting that all of those reports about weakening U.S. demand can't be true, unless that is we're seeing imports being pushed in ahead of any potential Chinese tariffs and exports being driven perhaps for other reasons, but they'll be pointing to the export data because you can see here when you look at exports of goods and services in blue in billions of dollars against the NASDAQ 100, you see a nice relationship here that where, of course, exports and the economy goes, the NASDAQ follows. So again, you're going to see a lot of articles now come out and push investors to be buying here, particularly since this is exactly what the hedge funds want. But remember, JPMorgan says, might not be over yet. And as we know, the machines may not have sold because the hedge funds may have put a stop to that. And yet survey results from the Institute for Supply Management paint a mixed picture of the July trade. The group's index of manufacturer exports contracted, which is not good. That happened now for the second month, while service providers' business overseas grew solidly. Of course, what we know is where manufacturing goes, services follows with a lag. But one hotel company says, no, demand's booming. Buy stocks. As Intercontinental CEO says, U.S. hotel demand defies economy fears. And again, you're going to see more of this now coming out to support why you need to buy stocks here. As long as the GDP continues to grow, as long as the middle class continues to grow, which I'll put that into argument, I don't think that's happening. Travel is something people are really preferring to do and continue to want to do. So we're very optimistic about continued demand growth going forward in the long term, although I don't think it's going to last a whole lot longer because that's in stark contrast with other parts of the travel industry. As Ryanair Holdings said, fares will tumble this summer as consumers pull back on spending, joining similar warnings from other airlines such as Lufthansa, Qatar, and Delta, suggesting that perhaps maybe the U.S. consumer isn't all that strong. But what we do know is this dip is going to pull money in. Hedge funds are going to look to spin the narrative to get retail investors to buy on top of them. But heed JPMorgan's warning. They're saying the carry trade isn't over. And if markets don't rally strongly and volatility doesn't come down, we'll watch for all these quantitative strategies to start unloading. And that means JPMorgan is going to be right. And this dip will not be the one to buy. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.